All right, so I have a question for you right out of the gate.
Okay, let's hear it.
If I told you that a book written way back in 1949, I mean, before the internet, before high-frequency trading, basically before the modern world,
Pre-everything, yeah.
and I told you that book is still considered the absolute Bible of investing, would you believe me?
I would, yeah, because I know which book you're talking about. And more importantly, I know who endorsed it.
Right. We're talking about The Intelligent Investor by Benjamin Graham. And the endorsement, it's not some random influencer, it's Warren Buffett. He says it's by far the best book about investing ever written.
Which is just a massive statement. I mean, think about it. Strategies that worked 5 years ago are often useless today. But Graham's ideas have survived, what, 75 years of chaos?
That's what we're digging into. We're using the revised edition, which is great because it has commentary from Jason Zweig, who kind of connects Graham's world to ours.
He bridges that gap, yeah.
But I'll be honest, when I opened it, I was expecting, a ton of charts, formulas, how to find the next big thing.
And that's not what you found.
Not at all. It felt, I don't know, more like a psychology book.
That is the perfect way to put it, and that's really the mission here. If you're listening hoping for a get-rich-quick tip, you're going to be disappointed.
Right.
Graham isn't teaching you how to beat the market. He's teaching you how to not beat yourself.
How not to beat yourself. I like that. We are usually our own worst enemies with money.
Exactly. The whole point is to give you a sound intellectual framework and then, and this is the hard part, the emotional discipline to stop yourself from wrecking that framework.
Let's start with the title, The Intelligent Investor. It sounds a little elitist, like you need a perfect SAT score to even try this.
It does, but he's using intelligent in a very specific way. It has nothing to do with IQ. In fact, he kind of argues a high IQ can be a disadvantage.
Wait, how can being smarter be a bad thing?
Because really smart people often think they can outsmart the system, that they can predict things. For Graham, intelligence is a trait of character, not brain power. It's patience. It's discipline.
There's a story in the book that just perfectly captures this, and it involves someone who is definitely smarter than us, Sir Isaac Newton.
Ah, yes. The South Sea Company. One of the greatest cautionary tales ever.
So set the scene.
Yeah.
It's 1720. Newton is a certified genius. This guy invented calculus. He knows how the planets move, and he invests in the hot stock of the day.
Right, the South Sea Company. And at first he does great. He gets in early, stock goes up, he sells. Makes a profit of £7,000, which was an absolute fortune.
So he won. Game over.
He should have been done, but this is where the psychology comes in. The stock didn't stop. It kept going up, and Newton had to sit there and watch his friends, people he probably thought were dumber than him, getting fabulously wealthy.
The FOMO must have been physically painful.
It broke him. The madness of the crowd just pulled him in. So Newton, the genius, dives back in. But this time he buys at the absolute peak of the bubble. And then it popped, as they always do. The stock completely collapsed. He lost everything he made, and then he lost his original investment. He was out £20,000.
Today is what, millions?
Millions and millions of dollars, just wiped out. And he famously said, "I can calculate the motions of heavenly bodies, but not the madness of people."
Wow, that just hits so hard. It really proves Graham's point. You can be the smartest person in the room, but if you can't control your emotions, you're toast.
That's it. If you have a high IQ but low emotional discipline, you're going to get slaughtered. But if you have average intelligence and you're emotionally stable, you can do very, very well.
Okay, so character's key. Graham then draws this super sharp line between two words we use all the time: investing and speculating.
This is probably the most important definition in the whole book, seriously. In the media, anyone who buys a stock is just called an investor. Graham says that's just nonsense.
He has a three-part test, right?
A very strict one. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Anything else
Is speculation.
is speculation, full stop.
All right, let's translate that. Safety of principle. What does that mean in plain English?
Principal is just your starting money. So safety of principle means you've done the work, you've done the analysis to be reasonably sure that the business you're buying is valuable enough that your money won't just disappear.
So you're looking at what the business is actually worth, not just the price on the screen.
Exactly. A speculator looks at the price and asks, will this go up? An investor looks at the business and asks, is this worth more than the price?
It's like buying a farm because you know how much corn it'll produce, versus buying it because you hope some other guy will pay you more for it next week.
That's a perfect analogy. The speculator is betting on what other people will do. The investor is betting on the business itself.
And the examples of speculation for the dot-com bubble in the book they're just hilarious and terrifying at the same time.
That whole era was a masterclass in mass delusion.
You have to tell the Juno online services story.
Oh, man. Juno. Yeah, they were an email company.
And their brilliant business plan was to give everything away for free and spend a fortune on ads. Their stated goal was to lose as much money as possible.
Which, in a sane world, would make the stock worthless.
But it's 1999. The stock goes from $16 to $67 in 2 days for a company that was literally promising to burn cash.
That is the definition of speculation. There's no analysis there, no safety. It's just a bet.
But my favorite one, the one that made me laugh out loud, was the ticker symbol mix-up.
Oh, the Ticketmaster one. It's a classic.
Yes. So Ticketmaster Online is going public. Huge hype. The ticker symbol is TMCS.
Right.
But people are in such a frenzy, they just start typing, and they pour money into a stock with the ticker TMCO.
Close enough, I guess.
You would think. But TMCO was Temco Services, a tiny janitorial company. They cleaned buildings.
No, a janitorial service.
Yes. People were buying a janitorial service thinking it was the next internet giant. Just because the letters were similar, the stock tripled.
That is the complete opposite of thorough analysis. People weren't buying a business, they were just betting on letters on a screen.
Now, Graham isn't saying you can never speculate.
No, not at all. He admits it's fun, it's exciting, but he says it's fatal if you think you're investing when you're actually speculating. You have to know which game you're playing.
And if you just have to scratch that itch.
He has the mad money rule. Take a tiny piece of your capital, maybe 10% max, and put it in a totally separate account, a gambling account. If it goes to zero, oh well, but you never, ever let that contaminate your real investments.
Okay, so we know what not to do. Don't gamble with your retirement money. But what should we do? Graham splits investors into two camps, the enterprising and the defensive.
And again, the words are a bit tricky. Defensive sounds weak, like you're scared.
Right, like you're hiding your money under the mattress.
But it's not about bravery, it's about effort. The enterprising investor is basically a pro. They're reading financial reports for fun, they're hunting for deals, it's a full-time job.
Which is not most people. I mean, I have a life.
Yeah.
I don't want to spend my weekends reading SEC filings.
And Graham gets that. That's why he created the defensive investor strategy. It's for normal people who want good returns safely without making it their entire life.
So what's the plan? If I'm not picking stocks, what do I do?
You use a simple, rigid formula. The classic Graham advice is the 50-50 split. 50% of your money in high-quality bonds, 50% in a broad mix of stocks, like an index fund today.
50-50, it sounds almost too simple. I mean, is that really it?
The simplicity is the point, but the real genius is what you do next. It's called rebalancing, and this is the mechanism that forces you to be smart.
Okay, walk me through it.
Let's say you start with $10,000, $5,000 in stocks, $5,000 in bonds. Then the stock market has a great year. It goes up 20%. Now your stocks are worth $6,000.
Okay, so my portfolio is now 60-40.
Right. And your emotional brain is screaming, yes, I'm a genius. Let it ride.
Of course.
But the defensive strategy forces you to say, nope, I'm out of balance. You sell $1,000 of your winning stocks and buy $1,000 of your boring bonds to get back to 50-50.
Wait, I'm selling the thing that's working to buy the thing that's not? That feels so wrong.
It feels awful. It's like cutting your flowers to water your weeds. But look what you just did. You automatically sold high. You took profits off the table.
And I guess when the market crashes, it works in reverse.
Exactly. Stocks tank. Now you're at 40-60. You're forced to sell the safe bonds and buy cheap stocks. You're automatically buying low. The system removes emotion and guesswork.
I like that. It's a system. Now, Zweig updates this common rule I've always heard. Subtract your age from 100 to get your stock percentage.
Right. The old rule of thumb. If you're 25, you should be 75% stocks.
It sounds logical, but Zweig says that's way too simplistic.
He says your circumstance matters way more than your birthday. He gives this great example of an 89-year-old versus a 25-year-old.
Okay.
The 89-year-old has her house paid off, a solid pension, good health care. She doesn't actually need her investment money to live on. It's for her grandkids.
So she can afford to take risks. She has a safety net.
A huge one. She could be 100% in stocks. Now, the 25-year-old, he needs his money in 2 years for a down payment on a house. If the market drops 40%, his life plans are wrecked.
So even though he's young, He needs to be more defensive.
Exactly. Your risk tolerance isn't about your age, it's about your timeline and your needs. When do you need the money, and what happens if it's not there?
That's a much smarter way to think about it.
Yeah.
Okay, we have to talk about the silent killer in all of this. Inflation.
The great enemy.
Graham talks about this thing called the money illusion, and I think we all fall for it.
Oh, constantly. Our brains are wired to see the number, not the purchasing power behind the number.
Give me the example.
Okay, scenario 1. You get a 2% raise, but inflation for the year is 4%.
I mean, my paycheck is bigger. I probably feel pretty good.
Right. Even though you are 2% poorer, you can buy less stuff. Now, scenario 2. Inflation is 0, and your boss cuts your pay by 2%.
Oh, I'm furious. I'm updating my resume.
But you're in the exact same financial position in both cases. That's the money illusion. We hate seeing the number go down, even if our real wealth is identical.
So inflation is this hidden tax that just eats your savings while you're not looking.
And if you just hold cash or safe bonds, it will crush you over time. The number in your account stays the same, but its value just melts.
So stocks are the answer to fight it?
They're the main weapon, yeah.
Yeah.
But Zweig adds a couple modern tools like REITs and TIPS.
Okay, quick breakdown. REITs are?
Real estate investment trusts. Basically, you're buying a tiny piece of a huge portfolio of properties, office buildings, malls, apartments. They collect rent, and rents tend to go up with inflation.
A pretty good hedge. And tips?
Treasury inflation-protected securities. They're government bonds, but they have this special feature. If inflation rises, the bond's value automatically rises with it. It's like an insurance policy.
So the goal isn't just a bigger number, it's protecting what that number can actually buy.
That's what an intelligent investor does. They protect their purchasing power.
Okay, this brings us to the final big idea, the market itself. Graham has this incredible analogy for it.
Mr. Market.
I love this.
It's just brilliant. He says, imagine you have a business partner, this guy named Mr. Market, and he's manic depressive.
A little emotionally unstable.
Completely. Every single day, he comes to you and offers to either buy you out or sell you his share at a certain price. Some days, he's euphoric. He thinks the business is the greatest thing ever and offers you a crazy high price.
And other days.
Other days, he's in total despair. He's convinced the world is ending and offers you his share for pennies on the dollar.
And the mistake we make is we listen to him. We let his mood dictate our feelings about the business.
Yes. When he's happy, we get greedy. When he's terrified, we get terrified and sell.
When really we should be using his mood swings.
Exactly. The intelligent investor treats Mr. Market like a servant, not a master. When he's offering you a foolishly high price, you sell to him. When he's offering a foolishly low price, you buy from him. The rest of the time, you just ignore him.
But that means you have to ignore the headlines, the shouting on TV, everyone saying, this time is different.
This time is different. The 4 most expensive words in the English language. Every bubble has people screaming that the old rules don't apply.
The pendulum always swings back.
Always. And because you never know when, that leads to Graham's final, ultimate principle, the margin of safety.
This is the real secret sauce.
It is. He uses an engineering analogy. If you're building a bridge that needs to hold a 10,000-pound truck, you don't build it to hold exactly 10,000 pounds.
Of course not. You'd build it to hold like 30,000 pounds, just in case.
Right. You build in a huge buffer, a margin of safety. Investing is the same. It's all about the price you pay.
Give me a real-world example.
Okay. You do your homework on a company, and you calculate its real value is $50 a share.
Okay, $50 is what it's worth.
If the stock is trading for $48, do you buy it?
Well, it's cheaper. So, yeah.
Graham would say absolutely not. Your calculation could be wrong. The economy could turn. There's no margin of safety at $48.
So I do nothing.
You sit on your hands. You wait. You wait for Mr. Market to have a panic attack and offer you that same stock for $30. Now you have a $20 cushion. Now if you're a little bit wrong, you're still okay.
That requires so much patience. It means doing nothing while other people are getting rich.
It does. And that brings us right back to the start. Intelligence is character. It's the discipline to wait for the right pitch instead of swinging at everything.
Let's wrap this up. We've gone from Isaac Newton losing his fortune to the nitty-gritty of rebalancing.
At its core, The Intelligent Investor is a book about facing reality. It's about admitting you can't predict the future.
And admitting that you're an emotional being and that your emotions are your biggest enemy in this game.
And it gives you a system, a defensive allocation, rebalancing, a margin of safety to protect you from yourself.
The big takeaway for me is how liberating this all is. You don't have to be a genius. You don't have to be glued to your phone. In fact, you'll probably do better if you aren't.
Absolutely. The less you look, the less you're tempted to react to Mr. Market's moods. You're just opting out of the madness.
So, a final thought to leave you with. Graham says the market is a pendulum, always swinging between wild optimism and unjustified pessimism. Take a look around right now. Look at the headlines. Look at your own feelings. Where is that pendulum? And are you pushing it, or are you waiting patiently to catch it on the swing back?
That's the whole game right there.
Thanks for listening to this deep dive. We'll catch you on the next one.